Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a mediator and business valuation expert in St. Louis, Missouri. Today, we are discussing the importance of a second valuation opinion with Michael Koeppel. In his 30 years of experience, Mr. Koeppel has been exposed to a host of industries, but his primary focus is on technology, manufacturing, and service organizations. He's founded eCapital Financing, which helps startups in the LA area and Western New York regions. He also owns Lakelet Advisory Group, which is focused on turnaround situations, and he works with a lot of ESOP situations. So he has an amazing wealth of business information, but today we're going to talk about something very interesting, which is in the situation where we have business valuation people entering the space for whatever reason, right? We'll talk about a lot of reasons. When they're entering into the space, sometimes there is something off about the valuation, or you could want some additional, advice, maybe consulting. And Michael's kind of brought up this topic, and I think it's a great topic because we do see, you even see buy-sell agreements stipulate to hire, each person hires a valuator. And then if you can't come to an agreement and you're 10% off or something, then you hire the third valuator. And if everything, so we see that language. But what are you seeing, Michael, just kind of in general about this topic that really kind of interests you to talk about it?
Over the last couple of years, I've really been seeing an increase in the review of other business valuators. Before, the primary reviewer may have been the IRS, Department of Labor, for ESOPs. But today, given the challenges and the specific technologies involved and the complications between each industry and sometimes companies within that industry, they need an expert. A normal CPA or someone who does generic business valuators just doesn't have the degree of expertise to opine on that company in that set of situations. And they look for somebody who does that. We do a lot of intellectual property work. Ironically, one of the largest areas for us is music in Nashville. And that has such specific challenges with it that a normal business valuator, unless you've gone through and done scores of them, you couldn't relate to all the players involved, the royalty, the process, and everything. And we're often brought in not only to do the business valuation, but on several engagements, I would say about half the engagements, by a business valuator that the client has already selected. The attorney or the client or the judge would say, I recommend you give Michael a call. He's done X and X, and he can help fine tune your report or processes given the nature of the specific industry. And there's nothing wrong with doing that at all. And again, I think it's growing geometrically, and a lot of private equity firms are now getting a second opinion on business valuations and a buy-sell agreement, especially if there's intellectual property involved. You just don't want to use a multiple. They want someone who's valued intellectual property and can add some significant value to it. One of the challenges, and it's becoming especially significant challenge in the world of ESOPs, is that many companies will have their CPA do the business valuation. And in the ESOP, especially the first couple of business valuation, that's the foundation of everything, that business valuation. And you need to have an expert in there. And the other side, or even the trustee, will say, this just doesn't cut it. You got a 10-page or 20-page report. I really need a detailed business valuation as a foundation to what the value of this company is for the employees and going forward. And too often we try to be, and I've been a CPA for several decades. I don't want to date myself, but we try to be all things to all people. And you got to realize everyone has a niche in the value added. It gets to a point now with regards to even the Internal Revenue Service. I don't even consider doing my own taxes anymore. And nor should a CPA firm say, unless they have the niche and specialty. Even if they have the niche and specialty, and a big thing I'm finding now, including the big four, you have to be relatively independent. you don't want to be doing the business valuation and also opining on the financial statements or in other areas within the company.
Mm-hmm. Well, and you've touched on a few different areas, and I will say even from a divorce perspective, we're seeing a lot of times they'll be like, well, my CPA, they've been doing the books for the companies and the personal and the family and the extended family for decades or years. And, they've done a valuation or two in their career, and they would be great. They told us what the value is already. Those types of things I think are happening. I think that if we dial back the conversation just a tad, one thing that business owners may or may not understand is there's a nuance between when like everybody says, it asks what I do. And I was like, well, I'm an expert witness. And they're like, oh, you're an expert. And I was like, well, no, like I actually testify in court for financial things. Like if there's a number, I go in and say what the number is and how we got there. And they're like, oh, it's actually a thing. And so in this space of even business valuation or even accounting, we have different people that are expert witnesses or experts, and you're talking about that term loosely as well. And then we have people that have the same expertise but could operate as consultants. And this may become important as we go through this discussion because you can engage professionals for different purposes depending upon what you need. So how does this kind of fit into the second opinion situation?
I think the second opinion situation should be based upon the differences that a company may have or require. I do not recommend having a second opinion because you don't like the value.
Mm-hmm.
For example, you see that often with startups. They think they're the next Google and they say, well, you should be adding a couple digits to my valuation. And you say, you need a sanity check. So they'll keep fishing out there till they get someone who gives them that extra digit or two. That's not the purpose of the second valuation. I'm saying if someone is concerned about the methodologies utilized, they read the report and say, they really didn't understand our industry or our company. They don't realize how fragile this is, or they don't realize the niches of the product or the value added by getting the FDA approval or all these other circumstances. They need someone who can understand that. And the other thing is, Melissa, when you talked about working as an expert or versus a consultant, I cannot think of a situation where a true business valuer does not work with the whole team. They're not going off and doing that. You have to be able to work with the CPA firm. You look down with their financial statements. For example, later on, I'll be meeting with another relatively large CPA firm, going through the work papers and saying, why is this adjusted this way? I don't understand it. You're not questioning it. You just want to have a better understanding of the situation. And obviously, you have to work with the client and the attorney. It is more of an art than a science. And that's what people really have to realize with regards to business valuations. Let's assume that we can agree on the right methodology was used, but there's so many subjective materials in a business valuation that are based upon experience, facts, and the circumstances of the client. The discount rate. What are you going to use as your comps if you're going to do a market analysis? The asset, what type of appraisal are you going to use it for out there? I mean, you see some people trying to do an appraisal on the assets without actually physically viewing the assets, but that's another problem with that. Mm-hmm. And the other thing we're seeing more and more of is the courts themselves bringing in someone to review the work of others. And I've seen that right now with regards to a large bankruptcy. The trustee has two business valuations, one from one side and the other from the other side. And you call and say, well, this can't be the same company. One says the company is virtually out of business and its value should be zero or negative. And the other one thinks, oh, well, this is, the next Tesla. Mm-hmm. And he said, where does the truth lie in this? And we would be working for the court in that situation. And we'd be working with the two business valuators who did this. Tell me about this. Tell me about this, your art. Tell me about what you did in subjective, why you really think this discount is applicable. Why isn't this one applicable? And go through the things that are subjective. And I would say, in my experience, the number one challenge by far, maybe 1, 2, and 3, Melissa, are the fact that people do not properly document their assumptions. It is an art form and it's very subjective. If you think the discount as a professional is 22% and you got the proof and done some research and you lay out your justification, we may come in later and say, no, it should be closer to 30%, but understand where Melissa and her team were coming from. That's fine. But if you just put down a number in there, we will use other analysis to get the number. And that's the number one problem by far is the lack of documentation. The more subjective something is, the more you should document and substantiate it. You don't have to have a PhD dissertation in there with 2,000 footnotes, but you should have some footnotes and references in there. But based on your experience, how did you come up with that number? That's the important thing. We're not in there when you do a second opinion to question the opinion or the expertise of the other side. In most cases, we're just there to say, how do you just substantiate that number? Is it sustainable?
Yeah. And I think that, interestingly enough, that when we're looking at these different types of reports, I think it is important to understand the type of valuator you're working with. Like, are they doing a couple valuations a month? Are they doing a couple valuations a day? Like, this becomes important because the velocity of seeing things, like, we're in a very volatile environment right now. You need to see what is happening around you and with other companies that are in that same area. If this is the first time you valued something, I think that a lot of times when there is miscommunication, the valuator is not communicating the value in a proper way, or they're not supporting their value with research and third party. Like, it's not Melissa's opinion. It's Melissa and Shannon Pratt and this organization and BV Research and blah, 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 blah. It's like, how do you, or the IRS said it, but we've kind of gotten people to this point of like, okay, I get why somebody would want to look at this, but who is actually initiating a review? Like we're seeing this in litigation, and we're seeing this in estate, but is it the business owner? Is it an attorney? Is it where do you see people coming in and saying, hey, something's not right here?
Yeah, I would say right now the trend, and it is a trending of everything else like in business, is coming from the private equity and venture capital groups. They're the ones really putting up their money. They, the other party is the seller, and say, okay, our business is worth $15 million. And if you want to buy 20% of it, we'll charge you X. And the private equity firms are getting smart enough to know that they don't do their own business valuations anymore. I think has been a major problem. There's nothing wrong with that. I co-founded a very successful private equity firm. And we would just sit there over a cup of coffee and do it on the back of an envelope. Mm-hmm. Okay, this makes widgets, and the widgets are the multiple of all the other widgets companies are 4.6 times EBITDA, so we're 4.6 times EBITDA. But people realize now that's the medium at best, and you got to take into account the characteristics of the company. What's the upside? What's the potential for growth? Does it have the intellectual property it really believes it has? What's the value? And the other thing that's so important, and I think much more important on younger and private companies than public companies, is the management. That is the key. I'm a strong believer you can take a good management team, whether they're making widgets or overseeing software or medical devices. That same team adds a lot of value. Now, during the summer, I wrote a 3-part article just on that very, very topic on the soft cost. The most important thing, everyone says, you talk to business owners, and I belong to several CEO councils, and I'd ask throughout them, what's your number one asset? And they all say, employees. And I say, okay, what's the value of your employees? Your company is worth, say, $30 million. What's the value of your employees? What slice of the pie is it? If Barbara, the CFO, who was with you for 8 years, left, what's the ramifications? They haven't taken a look at the nuances, and that's one of the reasons you get a second valuation in there. Okay, did someone take into these factors, these most important factors. You just said the number one asset in your company. And how do they extrapolate that? If someone's not viewing and spending focus on the employees, especially in a service company, I question the valuation in and of itself, because employees are a high risk. We know what it's like now in the market with regards to employees, trying to get the right employees.
Right. And I think that, even what you're talking about is having, when private equity is coming in to buy a company or something like that, doing the valuation. And what we're seeing is also the consultants are coming in and doing a valuation on the seller. And it may not be known and it may not be enunciated in writing, but the analysis is happening. If there is an actual valuation and process. We're also seeing a review traditionally in litigation or estate. It's just that you don't like the value and you're wanting to seek an additional party. To me, it really then becomes important for the valuator to understand how easily things move the needle. Like if everything in your valuations is contingent upon the company receiving the highest cash flow that it's ever received in the history of its life going into the future, like what is the substantiation for that assumption? And if it is preposterous, like I do a lot of litigation and I sit back and say, would the judge think this is crazy? Like if when you look at it, we're valuing, these sunglasses at $1 million, like you better tell me that there's diamonds on these sunglasses or else there's not a chance in hell I'm going to believe that. Now, that could warrant a second opinion, but that's typically like, why did you hire the person in the first place? Like, was that a related party? Was that something? Or when we're doing this, there is in some of the organizations that I am in and maybe in you are in, we have review processes. We have ways that we have even internally reviewed other people's work. Like they pay us, like people pay me to review their work or to help them and probably pay you. But when you're doing a review like this, because there are some rules for us, but when you're doing a review, what kind of review do you undertake? Like when you're assessing that business valuation that's done by some other valuator, like, do you have like a process, a method, or are you just saying, they're totally off, they're totally right or wrong, right? Like there's a process, and I think people don't understand.
The process, you're right. There should be a process. There needs to be a process. If given a report and they've asked us in the software, we do a lot of software analysis and business valuations, and they'll say, could you please take a look at this? Number one, what's the experience of the evaluator? You can't beat experience. You just can't beat experience. The first section you go to, at least I go to, is the bio section, believe it or not, and say, okay, they've really done this, they're educated, they've learned the tricks of the trade here, and that's fine. And they belong to these associations. He or she's been doing this for a decade. They publish something in this industry or something. That's fantastic. Then the next thing you go to and say, okay, what are the assumptions they made? Are there reasonable assumptions? Mm-hmm. And what's the methodology? Let's use your example you just delineated. Is they had a fantastic year immediately post-COVID, once in a lifetime, once in a generation year because of that. Are they using that as their basis for the valuation? In some places, that could be very misleading. Maybe you have to put in some adjustments, or at least note that, or say, use an average of the last couple of years, or do some realistic, or have someone do some realistic projections on what the reality of it is going forward, because you can't expect, that utopia, that, the unicorn to come in every single year to help you out. And then you look at the subjective side. If the basic foundation stuff's in there, the basics, I'm talking about the loosey-goosey income statement and balance sheets, no cash flow in there, you have some concern even before you get to the professional subjective nature of the methodologies, the discount rates, what they use in the build-up rate, and how they do that. What are the comparables that they're using for the competitors? Are they using Fortune 500 companies and this is a startup in someone's garage? I mean, what's the comps? And you have to go through the process. I try to put myself in their shoes for a few moments and say, okay, given what they learned or given what they have, it's not a perfect world. And I cannot envision doing an opinion about someone else or opining on the work without talking to him or her. I would call up hypothetically and say, Melissa, I was concerned that the gross profits for 22 and 23 are extremely arbitrary. And you could say, well, the reason was because of X, Y, and Z. Or please appreciate, as I noted below, they lost the control and they still haven't closed the books for that, but we're required to have a value. So I extrapolated based upon these industry numbers. Maybe it wasn't documented properly. So, okay, that makes sense. But you have to talk to the other professional and treat the other party like a professional. They are. Mm-hmm. As we take a look at other people's reports, others are looking at our reports on an almost daily basis. So you treat everybody fairly.
Yeah. And I talk to, so I do a lot of mediation where I'm sometimes the only expert in the room. Right. And in those situations, you're trying to kind of talk about these topics in a very transparent way and say, like, here's the issues and they're gray. But here's the risk, here's the cash flow, here's this. When you are just the single expert, and and I will tell them, I will say, listen, I'm going to provide you guys with some, the concepts of value, and you're going to go talk to somebody about it. And you're going to take these pieces of paper to somebody and they're going to review my work. I want to make sure that whoever you go to, if they're smart enough, they're not going to find red flags in my reports. They're not going to find those things, or they're going to find it supported. Now, I support my work in court, so I'm used to that. Right. A lot of times we're coming in and doing like if I do a rebuttal report, I'm going to say, well, I think that these were incorrect. Like your assumptions were not great, and this is why. Sometimes we're not coming in and saying that it could be different or better or worse. We're just identifying some of the issues. So I think the more professional you can be about identifying issues and having that discussion is very helpful. But there's also times when we are called and we maybe shouldn't review the work of another business valuator. Like, what types of situations would we be in if we should just be like, no, I don't want to go there? Like, I mean, besides like normal conflicts, but where do you see this happening?
Other than the normal conflicts, and I think for evaluators, the code of ethics really spells out the do and don'ts with regard to that area, Melissa. But in addition to that, when you do the business valuation, if you look at a report, and they usually, before you even sign up for the engagement, someone will say, okay, here's the report from XYB business valuators. And you look at it and say, it's pretty reasonable. I mean, I may have a discount value here, or I may not use this interest rate. And, in the back of my mind, I figure it'd probably be an immaterial difference, but there's nothing wrong with the report. You just don't like the conclusion of the report, maybe. But the report of itself and the professionalism utilized in the report, I think should stand on its own. The value, when you would want to walk away from it, is in many cases, if you know in advance, it's a very litigious no-win situation. You cannot even get the proper accounting records, and you do a lot of work with divorces and business valuation, and you see that often is that you're spending more of your work getting subpoenas and depositions just to get some basic information. For example, the revenue earned, or what the discounts are, or who owns the car, and going all through that. Life's too short for that. You want to work with, and where possible, with a very a professional set of clients who understand that. See, when you do the mediation, Melissa, you have a significant advantage in that you understand the business valuation and the processes. You really do. So, but let's be very real. A jury does not. If it's a jury trial, oh my, because they're not experts in that. And in many cases, neither is the judge. You spend a lot of time trying to explain it to them. That's why I don't want to say contingent on who the audience is. The glossary is a very important part. You really got to say, this is what the fair market value means, and this is what it doesn't mean. You really have to educate. But say your average report, 60, 70 pages. Other than yourself and the other business valuator, no one's going to read that.
Right.
And they don't understand the nuances of that. And that's very important. But you also don't want to be known to be out there to just find fault with other business valuators for the sake of doing that. You got to take a look. What's the true value I can add with regard to the proposition? And the other thing I would say, when I don't, is when they're not happy with the results, even though the process appears reasonable and the assumptions appear reasonable, but they're just looking for different results to shop it around. It's the same concern I have when used to be an auditor, putting an auditor hat on, when people would shop around for an opinion. Could you live with this if we account for it this way? I don't want to touch that. That's a no-win situation. You want to be able to say, look, this is my professional opinion. This is what I do going forward. I can live with that.
Mm-hmm. Well, and small businesses are messy. And I think that, when you're in litigation, people think that there's fraud happening. There's a lot of movement from an accounting perspective of money into personal and business. And people are like, oh my gosh, people didn't pay their taxes for 20 years. And like, who would do that? And I was like, all of my clients,
Yeah.
we see all of this stuff and things aren't clean. Like we're not going to have these perfect scenarios. But also, I think that in the process of reviewing other people's work, I typically, even if we're doing it in a court situation, I'm typically looking for 3 major issues, right, that move the needle. Because if we're gonna argue about a percentage point or 2 in the cap rate, or if we're gonna talk about it being like $25,000 difference in the cash flow, we don't have issues. We're both in a reasonable range. We're just at 2 different numbers. It's really the issue of when you are almost bastardizing the process in order to get to a number. And that's really a hired gun valuator, right? So that's going to be a reputation that follows that person that you need to be mindful of. But also, in just looking at the work, we can come in and say, okay, here's the 3 issues. I think that you are not in a reasonable range here. I think you are not in a reasonable range here. And here's why. Now that doesn't necessarily mean I'm going to come up with a new number. I'm just critiquing that report. A lot of times we'll see it in a very back office type of thing where we're like, okay, we got this report and somebody calls me and says, hey, can you just take a look and see if it's off? And again, is it off by millions or is it off by like 100,000? Because if we can give them a range, right, based on that. So we run the valuation and then take those subjective pieces and say, okay, what if they were different? What is the result? And if we can run the calculations and the result is still like, you're still in that same range, we are giving feedback that it is reasonable, not necessarily that it is perfectly proper, right? We're not validating that they are nobody is perfect in these situations.
It's a challenge, though. And I find that's a significant challenge. And I would say, before we do it, the engagement letter is so important in a review. It's so important. They expect another business valuation, and sometimes it's really a multiple step dance. They will engage us and say, what do you think of this? And I say, I am challenged that they didn't use the market approach with regards to that. And guess what? And I will put that in a letter or something, and that's the report. I'm not going to quantify if they would have picked these groups of companies unless that was part of the initial engagement. Now, often they would look at that and say, oh, that makes sense, Michael. could you reassess this situation if you were using a business valuation? I said, well, I'd have to reevaluate it. I'll make the assumptions that their financials are correct. Unless you want us to really dig into it, let's make the assumption that they're correct. And then I'll look at the methodologies they utilize. And if they would have utilized the methodologies I delineated in your letter, it's almost another engagement. Mm-hmm. Too often they expect you give them a report and say, oh, guess what? The marketability issue just doesn't stand to have any merit. Well, what's the ramifications? You say, well, that's not our engagement. We were engaged to tell you if this stands on its own or if I'd have some concerns with it. So you really got to spell that out in the engagement letter and educate them as well.
Mm-hmm. And I think a big part that people may not understand and we haven't talked about is that I do a lot of negotiation for deals, for litigation, for mediation. Everything in the world of finance is a negotiation. Okay. So these business valuations are a point in time, in space, that is an idea of a value, right?
Yes.
It doesn't necessarily mean that it is perfection. It is going to tell, so the business owner comes in and says, well, this value, this is the value. It can't be anything else. In reality, it is a premise to a negotiation. So even if they've put forth a valuation, that is their negotiation. That is their support for the negotiation of that number. You're coming in also and maybe saying, okay, if that would have been different, or could I support a different version of this reality? Again, it is to set the stage for a negotiation between these 2 points. It is not necessarily like the word of God,
Yeah.
And so
it's not cast in stone, Melissa. And the key is, as evaluators, we know our assumption pages are pages and pages. If you follow all these assumptions and, if the snow in Tibet is 16 feet or whatever, and you keep going through, that helps guide us through it. But another professional business evaluator in the same firm could probably do the valuation. It's going to be a little bit different. I mean, as you know, the discount rate, add 1 or 2% to something, which is very subjective, you got a different answer.
Right. Is there any times when it becomes inappropriate for us to assess the work of another evaluator due to conflicts of interest, or where would you see difficulties there?
I would see the difficulties there if there's a conflict. We go against many of the same firms over and over again versus our niche, and they go through us, and it's professional respect, right. And that's not a conflict of interest. Conflict of interest may be if one of our largest private equity firms gives us a significant amount of work and they're on the other side of the table. I even though it may be within the code of ethics, I won't, even if the other parties waive that and they have offered, oh, we can waive that, Michael, we want you to do that. For example, in the music industry, the nuances. I said, I'm not comfortable doing that because it's a no-win situation, and even the perception. Mm-hmm. It's always not the independence itself, it's the perception of independence that could be a problem down the road. Mm-hmm. And the other thing, if I really take a look at it and not comfortable, that's going to add any tangible value. I mean, we got enough work to do. You don't want to do something to take someone's money or take through it. Now, you may go through the process and say, guess what? It's, as using your analogy, it's within the range. So, the difference is immaterial. Despite we may use the different methodologies, the difference is immaterial. But you want to go into something knowing that it's not going to add tangible value. And you also, the only other thing I would say is, when you do a review of another professional's business valuation, it's got to be very thorough, because 99% of the time, your review is going to be scrutinized and compared to theirs. You say, okay, Michael, if you say that just why, tell us why the predecessor, the initial review was wrong. So you have to be able to substantiate and feel very strongly about that opinion.
Mm-hmm, mm-hmm. Well, and I think in some legal disputes, we will have situations where we have multiple opinions and we have multiple providers. And I will tell you that, I feel like I do a velocity that's a lot higher than a lot of people that I know in the profession. And based on that, I can see certain patterns in other experts and when they differ from their patterns. And I think that you have to be mindful about that as a professional. And as you do work, especially if you're highly concentrated in an area, or even as you start to go more national and operate around the country, like this is very important when you differ from your own patterns, right? So I think that a lot in valuation is being consistent until you change and then be consistent for that methodology or change, right? Not that every valuation is same, but if you're going to evaluate something, you can't start taking sides. You almost have to work individually on your neutrality, because the stories of people will always encourage you to be like, yes, it is worth more, or no, the sky is falling. Like these are going to be impassioned business owners. And I think that you have to understand, you have to be able to match. Does the financials match what the story is? Because if that's not matching up, there's still going to be a disconnect. And, are there strategies that you look at to kind of help you not be biased? Like how do you remain unbiased when you review another evaluator's work, even if you're seeing them back and forth? And I think professional integrity is one of them. But, what else do you see? Because it is important for us to not put ourselves in a position where we're kind of burning bridges in our own community, right?
Yeah, the strategies to be unbiased, it's very, very important. Every client, every case, every business valuation is different, whether it's the same industry or not, and you have to work within those parameters. You have to treat the other side very professionally, because they're going to be reviewing your work sometime and vice versa, and there's nothing wrong with it. The vast majority of our work gets reviewed. We may not think of it, but the IRS and Department of Labor for ESOPs, they're constantly reviewing our work. You just may not be sitting across the table from them, but believe me, there's someone in the country reviewing it, dotting the I's and crossing the T's. You treat the other professionals as you would want to be treated. If you have a discrepancy of it, pick up the phone or go down to their office and say, please help me understand this situation. You never want to surprise the other party unless you really don't want to surprise the other party. You want to give them some professional courtesy of what's going on, saying, I strongly disagree with this opinion or this approach, or you not at least taking a look at a discounted cash flow methodology. I'm concerned about that. If you would have done that, the difference would have been material. We think you should have. And then, so when they see your report, they say, oh yeah, we expected to see that from there. And to be very candid with everyone. Now, it all depends on who your client is, whether it's the attorney and you have client-attorney privilege, or the company itself, is what you can communicate to them in regards to written correspondence. And I think the written correspondence is very important. We've become so informal. I think maybe too informal in this work, because if you're reviewing someone else's work, sooner or later it's going to be come in front of either a mediator like yourself, Melissa, or a judge. You want to have a path to tell, even if it's a note, without prejudice. Please understand, you want to try to send them at least an email and copy the appropriate parties on it, so you can build up your case for it. And just be candid with them through it. So you just don't pick up the phone and talk to the other side, but then document. Say, for a conversation, I wanted to stress to you the following couple of points. Could you please help me understand the differences between these points? And sit down and have a conference with them. I think that's the other thing to help them be unbiased. And the other thing, remember who your end client is, and just be candid with them.
Yeah.
It's tough. Sometimes it's very, very tough to tell a client, you got an ugly baby here. Mm-hmm. Given what the fact that they didn't have the financial statements, the other party didn't have X, Y, and Z, they did the best they could, and we can't, we don't opine on it, or we got to make such absurd assumptions that you really want us to proceed.
Yeah, and I think that my experience with working with other experts is that I prefer to work with other experts that are above board, that I believe that I am, right? I prefer to work with, I don't need we don't need to work together to make sure our numbers connect. I need you to be independent and I will be independent. And if we do similar decent work, like, and we do have those conversations, because I do want to make sure, like, are you seeing this cash flow the same way I'm seeing it? Right? Because if we both come in with different cash flows, we saw the same information. If we're talking about, like, well, I think it should be up here and I think it should be, that's fine. Those are assumptions. But I don't care what the situation is, if there is another valuator involved, I will request, even if everybody is uncomfortable, even if it's in litigation, to have that conversation before we put anything in writing.
Yes.
Because I only will, and this is for anything, I will only email things that will protect me, but I will not email things that will destroy you. Okay. So I will have conversations with you about the things that I am really concerned are going to destroy your credibility in this process. Or maybe you didn't get this right. Like, maybe it would be better for you to come back and say an adjustment in your valuation because you didn't understand something, than for me to come in and say that was incorrect because you didn't even understand valuation theory. And so I think
you don't want to go the gotcha. No, you want to
No.
give them the professional courtesy. And you're right, Melissa. It's the thing. It has to be the evaluator's professional opinion on these things. And you're going to get pressure from the counsel, especially on product liabilities and other things, saying, well, I think it could have got a little bit more money on this, or I think their margins would have went up if it wasn't for the matter associated with this case. You got to use your professional opinion. Now, they can give you information that you may not have been privy to, and that may impact your decision, but the decision has to be yours.
Yes, absolutely. And I think this was a really good discussion today, because I think that more of us are entering in. There's so much strategic things happening. There's so many combinations of business entities or startups or failures or this or that, or buy-ins and buyouts, that we're always coming up against other experts. I also think that there are less experts out there. And so that we really, like, we are a reflection upon the entire industry. And I've talked about this in a lot of public forums of, like, we are the problem. And so if we don't start to do our job and check the attorneys and put everybody in their place, that we are the expert and we know this, then you're going to continue to get that backlash of, like, somebody telling you how to do your job when they don't understand what your job is. And right. I think that that's the part of the issue. But also, knowing other people that are willing to review your work but not, like, tear you down, I think is also important. Like, our goal is to help each other and to help the court or the purveyor understand the value. And so if you can't communicate that, and somebody can come in and say that you not only didn't communicate it, but you messed it up, that's going to be a problem. But Michael, I'm going to show some information about how they can contact you, and maybe you could give, like, are you reviewing reports? Are you, like, I have some people that will call and say, hey, I'm an evaluator, but, like, I need somebody to look at my stuff to make sure, and, like, is this something that people could reach out to you for, or how would they connect with you?
Melissa, we do that. That's a significant part of our work, is to review the work of others and consult, maybe not even be the primary business valuator, contingent on the industry and the nature of it. And that's an important part. And the other thing, Melissa, it doesn't have to be adversarial, the process. And that's the thing. It just has to be personal. It never has to get personal. Just walk through it. And I think with regards to that, the attorneys maybe can shed some light on it. They can argue all day in court against each other and then go out for a beverage afterwards as best of friends. You just got to stand what's best for your client, stay within the rules, and conduct yourself professionally and ethically, and you'll be shocked at how much business you can get.
Yeah, absolutely. And I think if we all understand that it is an art and there is concepts of science, and that we are all kind of professionally trying to do the best work that we can, I think we can assist others, and, maybe not have, there's still going to be times where there's huge, like, I have a case right now where it's like, one is 2 million, one is 24 million. Like, how are we going to bridge that gap? right? Yep. So there's misunderstanding and there's positioning in there, so again, what do these things tell us? We have to understand it and kind of convey it. But I appreciate this discussion with you, Michael, and I'm sure we're going to have more discussions in the future. So reach out if you have questions. But Michael is a great resource, and I would prefer you call him about all of these hard things.
Melissa, please, thank you and your team for setting this up, and it's always a privilege to work with you.
Awesome. Well, we will talk to you soon. Thanks, Michael.
Take care. Have a great